what is a good example of an investment thesis for a private equity firm? So if you wanted to go and do something in some industry, what kind of a thesis do you think works? Or is it a good game plan that you guys will kind of go from a top down as you're looking for opportunities?
I think a good thesis has to be realistic and differentiated. You have to be able to clearly explain what are you going to do differently from what's already in the market.
Sure.
Or maybe you're copying something that's already in the market, but that is just not widely known yet. I think that, for example, Constellation Software is a large successful
Sure.
software acquirer. They had a tremendously successful thesis that niche VMS software businesses are underappreciated because they don't have a large addressable market, but they're powerful and sticky within their unique space. And that was not a widely accepted conclusion at the time, but Constellation turned that into a multi-billion dollar, hundreds of billion dollar business now. So that's a really prominent example. But from our standpoint, we start from an overarching thesis of what we want to be as a fund. And what are we good at? What do we understand? And so our whole theory is that we want to buy companies that are essential and non-cyclical, because our belief is that we're not good at predicting where the economy is going or where the different macroeconomic variables are going. And I've proven over time that I'm very bad at that. Just look at my stock portfolio and you'll see that for yourself. If we can try and ignore that noise and just focus on, let's find a business that is essential to its customers and that is low risk of technological disruption, then we can have an edge just by knowing that we're buying something stable and build from there. Is that a good thesis or not? That's for our investors to judge, I suppose.
Sure. I guess the inverse of that question then is, what makes for a bad thesis? I remember there used to be a guy I used to work for in New York, had a poster on his wall of a guy in a factory. And one guy said to his manager, he said, "Boss, we lose $3 on every widget." And then the boss says, "Don't worry, we'll make it up in volume." And so we said like the unprofitable, like unit economic just expanded to the world. And look, we've been proven wrong in the sense that like, look at like jet.com, like someone bought it for a gazillion dollars, but we said, fundamentally for a deal, like there has to be at least unit level profitability of some sort. But I'm curious, when you kind of hear other people's ideas of what's going to work and what's not going to work, what have you seen as a thesis? And maybe it is just kind of like betting on macroeconomic tide shifts. What is a thesis from your perspective that does not work, even if it can sound compelling in a 50-page pitch book?
So I'm going to half answer your question and say a thesis that I commonly see is the greater fool theory. Doesn't matter what we buy the business at today, we're going to buy a whole bunch of them and sell them for more later. And sometimes that is successful, but what people miss is usually the groups that are successful doing that are very talented operationally, and they do an exceptional job tying the businesses together, integrating them from an operations standpoint. And so they are creating real value under the hood. They're not just buying $10 million EBITDA businesses and calling it a $10 million platform and reselling it. That thesis to me rarely works because it's not you haven't fundamentally changed anything. The good buyers are going to see right through that approach, and they're going to value you as 10 separate $1 million EBITDA businesses.
Sure.
I think that the other thesis that I've seen go both ways is, oftentimes people like myself that come from a white collar, highly educated background will come into a more blue collar industrial business and say, I'm going to add in a whole bunch of new systems and KPIs, and I'm going to make a whole bunch of changes that are derived from textbook learning effectively.
Yeah.
And you miss out on all the industry knowledge that comes from running the business for 20 or 30 years.
Yeah.
And so I think buyers need to be really cautious and come into a deal with the understanding that you're never going to know as much about this business as the person you're buying it from, and just show respect for that. That doesn't mean you can't make changes. It doesn't mean that your changes aren't good. It just means that you have to make the changes in a way that's responsive and respectful to the knowledge that's already within the organization.
All right. So let's say we're in a deal then, and you've gotten to the point where you've kind of done your evaluation, you have the terms, you've negotiated them with the counterparty, you have an LOI signed, and now you're kind of running that, what we always like to say is the confirmatory diligence period. Like, we don't want people saying, this is my opportunity to say, do I really like it? We want this to be the opportunity to kind of get from LOI to closing. But in those situations, we always try to kind of get a pulse or feel. I guess the question would be, what optimizes, in your perspective, the chance that a deal gets from LOI to closing? So you say, okay, how do you know when you feel real good kind of at the signing of the LOI that, okay, we're going to get there on this deal?
I think step one comes from being organized. Like, if I were on the selling side of the table trying to vet buyers, I would say, who are you using for your quality of earnings? Who's your lawyer? Give me a timeline of what diligence is going to look like. And if they struggle to provide answers to those questions, that shows a buyer who's disorganized. And that's not necessarily a bad thing, but you're in for a less efficient, less higher risk diligence process. So being organized is absolutely step one. I think second to that is you need to go into it as a buyer knowing what are the big critical issues. Yes, the quality of earnings team is going to do their thing. They're going to come back with an EBITDA number, or we hope it's approximately where we expect it to be.
Sure.
That's the details, and they can usually be worked out one way or the other. I want to know going into an LOI what could kill this deal, and let's address those right away. In the first 2 or 3 weeks, I want to know the answers to those questions, and let's get them out in the open. Let's get comfortable with them. Let's get them resolved, and then the rest tends to move smoothly after that.
Sure. And so again, with kind of the inverse thinking of it, when you're starting things out and you say, oh, I don't like this, or what do you think the biggest risk of not getting from the LOI to the closing is in a deal? I know you'd mentioned organization being one of them, but anything else, any other color on that is super helpful.
Yeah, so we've had. I'm trying to think of the couple deals that did not get to a close. One of them was actually a change in law that happened during diligence. That was a real unfortunate situation for everybody involved, but couldn't have predicted it. So that's probably a unique case. But another one that I could think of that did end up closing, but had a pretty large restructuring of the deal, was misleading or unclear information on concentration risks. We spent a lot of time pre-LOI trying to understand customer concentration, supplier concentration, sales referral concentration. What are the different pools of risk in this deal? And if it turns out that it was represented to us that the top customer is 8% of sales, but that's one division of a larger organization, and 4 other divisions of the same organization are also in your top 10, well, that's a fundamental difference in the risk of the business.
Next question that starts to dig into that, is there one variable within a company that if you see, you'll be much more willing to kind of overlook any other deficiencies that you find along the way? Not all of them, but is there one thing that you say like, oh wow, that's really kind of a nugget here that we have to latch on to?
It really comes down to a feel for people.
Sure.
For me, that the one thing that gets me really excited about a deal is when I get a chance to meet the seller and get a feel for how they view their organization, what's driven the growth, what does their day-to-day role look like. And sometimes I come away from those meetings and think, man, I want to partner with this person.
Sure.
Because they know what they're doing. They've built a great organization. They seem credible. They seem trustworthy. They seem knowledgeable. And I have overlooked some really big risk factors because I believed in the founder.
Sure.
And on the flip side, I've walked away from deals that were on the surface good from a quantitative standpoint, but I just didn't feel that the founder was credible or genuine.
Sure.
So it's really hard to this is one of my challenges in running Kepler is how do I teach our team
Yeah,
that critical part of the deal? That's just something that comes from experience and comes from, frankly, making mistakes every now and then, and grinding through it. But that is the biggest factor for me that can swing a deal one way or another.
and so I guess is it fair to say then, because we're going to again kind of ask the counterpoint to the question of like something that you would stop or walk away from a deal for, no matter how pretty the deal was. Would that be similarly kind of the people element of it? And if, again, to the point where you feel like there's an insincerity or a lack of trustworthiness that you say, hey, I don't care how good this is, we're probably not going to do it.
Yeah. If I lose trust
Sure.
in the people on the other side of the table, it's hard to get past that.
Sure.
Um, and I think there has to be an acknowledgement that people make mistakes, people may forget to disclose information, or people may just be inexperienced. In many cases, for a seller, this is their first and only transaction.
Right.
And so I have lots of time and patience for that. But if I feel that there is an intentional effort to mislead or misrepresent something, that's it.
Yeah.
The deal's done.
All right. Now, two last questions here. First one is just on a general perspective. What is the best deal experience you've ever had? Best deal you've worked on? Could be the best for any rational or irrational reason, but from your career, is there anyone that sticks out as like, hey, that was just an awesome deal?
We sold a business this past May 2024, and this is publicly disclosed. It's a
Sure.
company called Bloomberg Consulting and got bought by a fantastic firm called Young and Associates. And that would be my favorite deal to date in my career. And once again, it comes back to people. We bought the business from a guy named Chris Bloomberg, who was a fantastic founder. He was exactly the guy you want to work with. He's trustworthy. He's extremely good at his craft, but also extremely good at running an organization. And he knew that he had come to a point in his career where he needed to step back from being the doer and the guy who does the work and executes on it, and step into a CEO who is strategic and focuses on growth and lets his team perform the work. And that was the thesis going into the deal, both from Chris and from us as the buyer. And it was just a scenario where we were perfectly aligned and had a tremendous amount of trust. And it ended up being a great outcome for us and for Chris and for the employees.
Sure.
Uh, and so it's hard to feel anything but really happy with how that whole deal worked out.
Sure. No, that's good. And then flip side of that, you don't have to include any names. What would be the worst deal experience you've had?
So I had a deal at a prior firm where we bought the business from a seller who was retiring. We ran a recruiting process, brought in a new CEO for that business, and the new CEO was exceptional. It's a great hire. We really nailed it. I made the mistake of undercompensating the new CEO. We got into a bit of a tiff in the hiring process, and ultimately I won. I won the battle. I lost the war.
Sure.
We had a better EBITDA in the short term because of the money we saved, but it meant that she was not fully aligned with the business long term, and a great opportunity came along, and she took it and gave us 2 weeks notice to hire the CEO of an organization, which is clearly not enough time to do it properly. And I remember the next day thinking, damn, I got to move to Colorado and run this business. And, as a buyer, you're kind of the last line of defense. If you can't solve the problem, you're the one solving it personally.
Sure.
Um, we did make it work. We hired someone in 2 weeks, but understandably, they weren't the best fit for the role. And it started a rocky road from there.
All right, good. So look, I think that is all of the questions here that I had at least, but I really appreciate the time. This has been super helpful. Everyone's going to really enjoy this. And I think, we get so many people saying like, I'd love to get better insight into precisely what kind of private equity looks at, how they evaluate stuff. And so I think they're going to enjoy this, hopefully not to the extent that they ask you to make 2 videos a week instead of me. But nonetheless, I do appreciate the time here. Thanks.
Thanks for having me, Arthur. This has been fun.
Sure thing.